Investors interested in capitalizing on the rising effectiveness of AI are understandably interested in Palantir and C3.ai stock. The two AI companies offer similar services to enterprises looking to harness proprietary data with AI to improve performance. Palantir is the premium product, but C3AI aims to capture customers who may not be looking for the best of the best and the prices they demand. In this video, I'll compare these two AI stocks across critical financial metrics, including revenue growth, profitability, cash flow, shareholder dilution, and valuation to determine which one is the better AI stock to buy for long-term investors.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Starting with revenue growth, going back several years and looking at a trailing 12-month period, we can see that Palantir demonstrates excellent revenue growth, increasing from 800 million in 2020 up to 2.5 billion in the most recent trailing 12-month period. That's more than 3x in that time. And recently, Palantir has re-accelerated revenue growth on the back of a quality improving product, the AIP, which has led to many new customers in the enterprise space. Palantir has always had a good position with government business, but recently it's accelerating its business with enterprises, and that's been great news for its revenue growth. C3AI has struggled to gain traction, 325 million in revenue in its most recent trailing 12-month period. It too recently started growing revenue again after several quarters of flat to declining revenue. C3AI has undertaken a similar strategy to Palantir, where it's employing boot camps where it goes into businesses, tries to show them what it can deliver, and then tries to make a sale after it demonstrates what it can deliver. And for both Palantir and C3AI, that strategy has proven effective, leading to many new customer acquisitions. Looking at operating income, we see a similar story, with Palantir making excellent progress improving its profitability from losses of over $1 billion in several trailing 12-month periods in 2021. The company has improved that performance to generate profitability on the bottom line for several consecutive quarters now, and in the most recent trailing 12-month period, 292 million in operating income for Palantir. C3AI, meanwhile, is heading in the opposite direction, 316 million in losses in the most recent trailing 12-month period, and you can see its losses are worsening over time. So its flattish revenue and non-growth in terms of the top line has led to increasing losses on the bottom line. Investors hope that its recent success in accelerating revenue growth could turn things around, but there's little evidence for that just yet for C3AI stock investors. Similar story again for cash flow from operations, with Palantir demonstrating phenomenal increases in this metric, from losses of 300 million in 2021 to 708 million in cash flow from operations in its most recent trailing 12-month period. Now, on this metric, C3AI is showing progress. It is showing demonstrated improvement. 58 million in negative cash flow from operations in the most recent trailing 12-month period. But you can see those are improvements from the bottoms around 2023. But also when you compare it with Palantir, you'll notice the big difference in improvement. Palantir is improving very rapidly, while C3AI in this metric is improving incrementally. Now, the next metric I wanted to consider is shareholder dilution. And the reason this metric is important is if companies like Palantir and C3AI are diluting shareholders, that means when or if they reach higher levels of profitability, the earnings per share will be lower because the number of shares outstanding will be higher. And so that's why I consider this metric important. Palantir is diluting shareholders significantly more than C3AI. And we can see here Palantir's shares outstanding have roughly tripled from around 800 million in 2020 up to 2.4 billion in the most recent period. Meanwhile, C3AI, it's been flat. It hasn't been diluting shareholders. And, importantly, C3.ai and Palantir, they have pristine balance sheets. They don't have any debt, and Palantir has over $3 billion in cash. C3.ai, not that much, but it still has several hundreds of millions of dollars in cash. So theoretically, they don't need to be diluting shareholders, especially not Palantir, because it's generating positive cash flow from operations. It's generating positive profitability, and it has several $billion in cash on the balance sheet. And so it can compensate employees using cash. It doesn't need to rely on stock-based compensation, which many tech companies use because it's a favorable form of raising capital. Instead of going to investors and borrowing money for the business that's losing money, tech companies often like to go to employees and say, what if we pay you in stock options or stock grants instead of paying you in cash? That way the business can conserve capital and you, the employee, get some upside in the business. If the business does really well, then you get to participate in that upside. If the business does not do well, then you also have to take consideration for the downside. And so many younger tech companies that are losing money on the bottom line employ this tactic because it's a low-cost way of conserving capital. But Palantir doesn't really need to do that anymore, so it's curious why it's still diluting shareholders. I wouldn't be surprised if Palantir starts a massive share buyback program to reduce those shares outstanding because it does have so much cash and interest rates are now on their way down. Yesterday, the Federal Reserve cut interest rates by 50 basis points. That means the incremental cash that Palantir generates, it won't be able to invest and earn as high an interest rate as it was doing over this last year and a half, 2 years, because interest rates were so high. So that may favor Palantir reducing its share count, but for now, it's diluting shareholders much more aggressively than C3.ai, I should say. And finally, I wanted to compare these two on valuation. And I chose to use the forward price to sales ratio because C3.ai is negative on cash flow and is negative on profitability. So I chose to use a forward price to sales ratio here. And looking at this metric, you can see Palantir has broken away from C3.ai. They were trading at similar valuations between 2021 and early 2023. And then Palantir broke free from C3.ai. And it's not surprising because Palantir's performance improved much more dramatically than C3.ai's, and their valuations went in different directions, Palantir increasing while C3.ai is decreasing. So now Palantir is trading at nearly 4 times the valuation of C3.ai. Still, if I was to pick one of these two AI stocks to buy today, I would pick Palantir because of its demonstrated performance improvement over the last year and a half, 2 years and a half. It's made significant progress on profitability, on cash flow, re-accelerated revenue growth. And so those key financial metrics are significantly in its favor, and it's enough to sway me in their direction in picking an AI stock to buy here. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.